welcome to the Investment Markets podcast, where we aim to discuss investment matters that impact self-directed investors. I'm your host, Darren Connolly, CEO at Investment Markets, and I'm delighted to be joined by Ivan Scherman, CIO and CEO of Skytech Investments and manager of the Ausbiz Capital GroWise Fund. Today we're going to discuss investment matters related to algorithmic trading. However, before we get into it, I need to remind you that this is general advice and general information only, and nothing in this podcast should be construed as an investment recommendation. You will need to decide what is right for you. Welcome, Ivan.
Thank you for having me here.
It's a pleasure. Now, Ivan, to kick things off, you've had a very interesting investment career. So, can you give us a little bit of an introduction to how it all started, how you got pulled into investments, and then how you won the World Cup?
Well, it started as a way to look for something different than what the market was offering at that moment, at the moment that I started. I started investing in passive funds, and they were supposed to be active funds, and after a while, after losing a few times, I realized that the decisions that were being taken at that moment by the people who were managing the fund were not data-driven decisions. They were interpretations of what the markets were going to do, what was going to happen with the economy, how the economy was going to impact the price of the different assets traded at that moment. So I wanted to look for a methodology that could extract the proximate behavior of the market, but based on facts, based on evidence. Evidence that can show me how the market behaved when certain circumstances appeared in the past, and if those circumstances could be translated into the future to make investment decisions. So that's how I started to go deeper into the using of engineering and science in order to make my investment decisions.
So you're removing all of those personal biases that a lot of those managers may have and making it much more quantitative. Is that?
Yes, fair? That's fair. Yes, because there are a lot of participants in the industry that still are using discretionary methodologies, and they work, but it doesn't work for me. So for me, I need to have the evidence that certain thing has worked in the past, and I need to have the evidence that I can translate that into the future, and that it's not going to work because of my opinion. That it's going to work because I recognize certain characteristic of a certain asset, a characteristic that could be normal for that asset, and that reflects the very nature of the asset, and it's not going to change in the future. So with that in mind, I created this kind of methodology that we use in the company, and it's a way to add objectivity and removing bias, as you properly said, from the investment decisions that we make.
Yep. So maybe for the people who are not familiar with algorithmic trading or what exactly it is, so maybe a quick introduction. Can you define it? Maybe just pull the curtains back a little bit, and for the uninitiated, what is it? What happens? What's the secret sauce? What's the magic?
Algorithmic trading is using a set of rules in order to translate certain patterns into a system that is going to be used to work in the market. I'll give you an example of a very simple set of rules that everyone can contrast those rules against the market to see if they work or not. The S&P 500 is in an uptrend. Of course, an uptrend should be interpreted by a machine. So an uptrend in this case is going to be the 200 moving average is greater than the 200-day moving average of yesterday. Okay, if it's greater than yesterday, it means that the market is going up. So you have an uptrending market, and the price of the S&P 500 closes negative for 3 consecutive sessions. That pattern precedes an upside in 85% of the times. So I gave you two rules that you can quantify, that you can program, and you can use to enter into a market. And when the price closes above its 5-day moving average, you close out the trade, and you're gonna be profitable 85% of the time.
And you're able to back test that as well,
Exactly.
I would guess.
Exactly. Yes, I think it's a very, very straightforward way to explain how an algorithm might be created by applying these rules. It's not something that we use, but it's something that everyone can check and backtest by themselves.
And I would assume sort of you've been doing this for a long period of time now. The track record, and again, not necessarily a guide for future performance, but the track record's been quite impressive. It's been over 20% for I think it's 18 years now. Is that
almost
correct?
19?
Almost
Yes.
19. Almost 19 years. So something is going right. The strategy then is being translated into a new fund called the GroWise hedge fund, Ausbiz Capital GroWise hedge fund. Are you translating the strategy exactly, or are there differences to account for this particular fund?
No, it's the same strategy. What the Ausbiz GroWise Fund does is it replicates what we do at SciTech with GroWise. So it's the same strategy that has been producing a CAGR of around 21% since the last 19 years. So what we wanted to achieve, what Ausbiz wanted to achieve, is to democratize this kind of strategy that is mostly reserved to wholesale and institutional investors for the rest of the public.
Yeah, I think it's fair to say most people wouldn't typically come across something like this in their normal portfolio allocation.
Exactly. Yeah.
Now, with that return profile, risk and return go together. Do you see the fund as being any more risky than other funds in the market?
No. I see the opposite. I think that most of the funds that you might find are mostly related to the general market, how the S&P 500 or the main market works, okay? And that has something called systemic risk. It means that if everything goes wrong, if you have a crash in the market, everything is going to move together. So those kind of funds are going to go down the same way that the market is going down. What we created was something much more agnostic, because we look for alpha in all kind of assets, in all kind of directions, in different trading methodologies, to try to get uncorrelated returns from every single strategy that we use in the fund. That would be we get that by trading different energies, different grains, different currencies, different markets, single names, all kind of assets in different directions and in different time frames as well. So in that way, if we have uncorrelated returns from every single strategy that we trade, what we create is a smoother equity curve. The drawdowns are going to be more contained, and we can cross a crash in the general market successfully. Why? Because let's say that there's a crash in the S&P 500. That's not going to affect our positions on, let's say, short natural gas or long rice or short soybeans.
So you are, this is the ultimate diversification. Across,
that's what we believe.
yes. So you're across markets, assets,
strategies,
pretty much everything.
Yes.
So the correlation to the S&P 500, for example, would be
close to zero.
Small. Yeah, very small.
Close to, yes.
All right. Well, that opens up the number of strategies then that you might be running. Are you running a lot of strategies at any one particular point in time?
Around 300 strategies, yes.
Well, that's more than any one individual fund manager could run for sure.
No. Of course, that's something that it has to be automated because it's impossible to do it by humans.
And could you just tease out maybe a couple of you gave one or two examples already, but where those strategies are playing out? So you mentioned energy, soybeans. Can you, just so people can get a picture of where you're invested, a few other examples?
Natural gas, crude oil, gold, platinum, palladium, soybeans, corn, wheat, single names, all kind of stocks, everything that can be traded in the regulated markets, we can trade them. If we can find a pattern in the data of the assets we trade, we backtest that pattern and we translate that pattern into rules and we create an algorithm in order to trade that pattern.
And with that process over the last 18, 19 years now, how has the sophistication of your strategy changed? Technology's changed a lot in that time. So for you yourself, as you're implementing this large number of strategies, have there been any kind of key technology changes that have made it easier? And then probably the second part of the question, if I may, is are there any new or emerging technologies that you think are going to make a really big difference to what you're doing?
Just to give you an example, in the past we used to use certain brand of computer, Falcon computers. They were machines for scientific processing, and they were really expensive, and not too many people could afford to buy those computers. Today, those computers are replaced by simple Amazon services. Just to give you an example. So perhaps in the past you have to use one of those computers and might cost $50,000 US dollars, and today you have the same capability by paying $300 a month.
Yeah, that's a huge difference.
So it's a huge difference. It's a completely different world that 10 years ago.
Yeah.
And of course, the analysis capability has improved tremendously. What we used to do in weeks, now it can be done now automatically.
So the processing power for the computers obviously has changed dramatically?
Yes, dramatically.
So does that mean you're able to process
and to store? One of the problems we had in the past was the storage of the data. We use a lot of data to train our models. And we need to have rooms to allocate our servers to store the data. And
it's like you have your own data center.
Yeah, we used to have our own data center, but now it's not something that is a problem anymore.
Yeah.
Because everything is in the cloud.
Yeah, and will further advances in AI or other technology increase your capability even further?
Yes. For example, in the past we used to have very static market regimes detectors. Today, with artificial intelligence, the market regimes are being analyzed in real time, and the brains we train in our company can read in advance how these market regimes change.
So they're nearly predicting the future.
They're not. It's not that they predict in the future. They are adapting their behavior to the reality.
Yeah. And I guess one of the challenges then is, do you still have a human overlay that sits on top of any of this, or do you push the algorithms better and just let them do the work?
All the ID work is done by humans. In a way, it's like making vaccines. You have a laboratory, you have a team in the laboratory, and they are all investigating different ways to take advantage of the data, or what the models that the data might present. Then, of course, we use technology in order to get to understand the different patterns, to get to process the patterns, to analyze the data in a more efficient way. But there are humans behind this ID labor that we do at the company. And then, of course, once the algorithms are prepared and being tested and ready to work, there are no humans executing, because it's impossible.
It's impossible.
To execute 300 algorithms for 12,000 assets in real time, it's not 24/7, 24/5.
Okay. Well, that's a huge amount of coverage that would not have been possible 20 years ago.
It was more difficult, but now it's easier.
Yep. And I know this isn't your first visit to Australia. When you look at the Australian market, do you have any takes on the Australian market? So there's not a lot of funds like this in Australia. Do you think there's an opportunity? What do you see when you come here? What are you struck by?
I like the Australian market because it's a very intelligent market. I've been reading that the participation of the people in financial investments is really high. And that shows a very intelligent approach to investments. And there's a bigger appetite for these kind of alternative products like the ones we have. And I know that the whole public is very concentrated in the main stock market. And that means
Australia is a very small part of the global stock market. Very small.
But it's correlated with what's going to happen with the rest of the markets globally. So if there's a correction in the S&P 500, a big correction in the S&P 500, the Australian market is going to suffer it. So there's a big opportunity for the ones who want to protect their investments from what could come from outside of Australia.
Particularly with what is a very uncorrelated and diversified fund across 300 different strategies.
Exactly, because that's what we're looking for. We want to provide uncorrelation and systematic returns without systemic risk. The way to avoid systemic risk is through diversification in different assets, different time frames, different strategies. There is no another way. We need to have uncorrelated returns with the market in order to protect ourselves from systemic risk.
And it's a very different approach, because there are other fund managers out there who might be running a standard equities fund, for example, and diversification is 40 stocks within the one market in the one country, and that's not what you would call diversification.
I don't criticize that. It's a different
approach.
Yes, exactly. What we think we do is that we can complement that. Those strategies generate alpha, of course. They work very well when everything is doing well. But our product helps them to protect their gains when everything goes wrong. So that's the most valuable thing that we can add to those kind of portfolios. But those are necessary as well.
And if we, in terms of protecting those gains, it's been quite a volatile few months. You might say it's been quite a volatile few years. What are the particular things that maybe you worry about So let me ask the question a different way. Is volatile better for your strategies? So is the volatility better? And secondly, do you make changes to the strategies given the volatility that you do see on markets?
Volatility is something that we want to take advantage of. By definition, we look for volatile patterns because they have much bigger movements.
Yes.
Okay. The possibilities of taking advantage of volatile movements means that we can get better profits. And if you have the proper size in those investments, volatile investments, and that the risk that they might show doesn't represent a big amount of your whole portfolio, you can have good returns with a very contained risk. Let's say that you have a very volatile strategy, but the risk that that strategy shows doesn't represent more than 1% of your whole portfolio.
Yep.
You will take advantage of it because if something goes wrong,
it's a small percent.
It's a small,
yeah.
Exactly. The risk is going to be contained, and you won't suffer a very high impact.
And with the strategies themselves, do they change frequently, or are they self-learning? Do they continually iterate when markets are moving?
No, we try to take advantage of behaviors that have been in the market for centuries. We understand that the markets are moved by emotions, and we need to detect the emotions that have been present in the human life for centuries. And that's something that hasn't changed, and it won't change because
people are people.
People are people, exactly. And we don't want to trade something that might work in this decade, and then it's going to change. So we want to trade things that are going to remain persistent during the time. And so what we're looking for is to find those kind of patterns, not patterns that are due to certain technological changes that might disappear in the future.
So you've always got an eye on the longer term in terms of the strategies that you put in place.
Yes.
That's fair.
Yes.
And then one of the other things that struck me was, for hedge funds in particular, fees are always front and center for investors. It's the first thing that they look at. Can you just tease out sort of your view on alignment between investors and the manager, and how that's been replicated in this fund?
When I started investing, I was charged even when I was losing. And that made me feel very bad.
Not good?
No, not good at all. So I wanted to give our customers the certainty that we believe in what we are doing. And to reflect that, we only charge when we produce profits. If we don't produce profits, we don't charge. And that's a way to, after all these years, that's a way to show the clients that we have something that must work, that is going to work, because if it didn't work, we wouldn't be here. And that's something that we are also doing now at Ausbiz Capital with GroWise, and we charge performance fee because we know how to produce that performance. So we don't have the need.
Over 19 years.
Over 19 years, exactly. And a lot of experience, and we wouldn't feel well if we charge the client when we are losing. Well, it's like getting a broker and paying the broker for not to get you the house you're looking for. So it wouldn't make any sense to me.
But it is, so you've taken the standard fee model and changed it to back yourself effectively in terms of delivering for the investors. Is that a fair summary?
Yes, it is.
Well, that's different.
We prefer to do it differently. Yes.
And the fund has been launched in Australia. I think it was launched in the end of September last year. Has there been anything since then that surprised you in terms of running the strategies for this fund, or has it gone exactly as you expected?
No, it worked exactly as we expected. We had a tremendous year, 2025. We delivered 37.7% net to the client. Of course, Ausbiz GroWise Capital was launched in September, so it didn't have the whole year, but it was a tremendous year for us. So, in fact, we were one of the most profitable hedge funds in the world.
That's a very high bar. So, congratulations on that result.
The first five.
Top five in the
top
world.
Five. Yeah.
And when people talk to you about algorithmic trading, it's not something that most investors, certainly probably more on sort of the individual investor side. What is the one thing that when people talk to you, they don't really understand? What is the one thing you have to explain continuously, and what do you usually say to people to explain it?
We have to, this morning we had a meeting with a very famous wealth management firm, global wealth management firm. And one of the questions that they asked was, how do we get to make our investment decisions? How will we get to discover these patterns? And we try to explain to them that the same way that when you're gonna build a bridge, you're going to observe the reality with certain tools. Tools comes from engineering. In the past, if you wanted to build a bridge, you would use the knowledge that you have available, and they will try to estimate how the wind is going to behave, how the floor is going to move, how salty the air is going to be. But today you have tools to do that
for you.
Exactly,
Yep.
to do that for you and to quantify it and to show you the reality that you need to have in consideration in order to build your bridge. It's the same way with trading. We use different tools from engineering, like acceleration, deceleration, that can read what is happening with the data of the market, and that can show you the patterns that are hidden in that data. And sometimes it's hard to explain to them how we do it because we are talking a different language. We are explaining to them concepts that come from engineering, not from finance, and that's challenging.
So the pattern recognition.
The pattern recognition and how we get to recognize those patterns. What instruments we use to recognize these patterns. For example, we use a lot of different instruments that are used in electrical engineering to recognize what is called white noise and to separate the white noise from the signal. And those are things that are not very well understood in the financial industry. They are understood in engineering.
Well, conceptually, I think they're understood in financial, but maybe not in the same way. Now, probably just to sort of to wrap up, when you go and you talk and you present the fund, what's your sort of last takeaway that you leave with investors? So you said you met a famous wealth management firm earlier today. When they're considering investing in the fund, what's your takeaway pitch to them? What do you say?
I tell them that we're not here to change what they do. We are here to improve the way they do what they do. If we can add uncorrelated returns to their portfolio, that means that we can make them make a smoother equity curve for their clients. In their own terms. Let's say that they judge their own portfolio by using Sharpe ratio, okay, which is a risk-reward ratio. If I add uncorrelated returns to your portfolio, that means that your returns are going to be smoother, that your volatility is going to go down, and that is going to be shown in the ratios that you use to judge your portfolio. So we are going to help you to become a better asset manager. We don't want to change what you do. We want to help you to improve what you do by adding uncorrelation into your portfolio. That's how we see it, and that's what we say.
And for individual investors, effectively, maybe it's sleeping better at night, having less volatility, or having to watch your portfolio and be worried on a day-to-day basis.
But having consideration this, you have your house, you have your company or your work. You have your whole economy linked to your domestic economy, to the macro situation of your own economy. So in a way, even if you don't want, you are linked to what's going to happen with the country, with the economy of your country. And you, in my opinion, you need to have a way to protect your wealth from what is going to happen with the economy. Because, as we all know, the economical cycles are that, cycles, okay?
They come and go.
They come and go, exactly. So you need to be prepared to have an umbrella for the time that the storm will show up.
Yep, and particularly in somewhere like Australia, which is the home biased nature of the Australian market, I think is well known. It's 2% of the global economy, but I'm pretty sure every single Australian has more than 2% of their wealth tied to this economy. So I can very much see how 300 uncorrelated strategies, or 300 strategies that are uncorrelated, can provide a different outlet for investors who are looking for that diversification.
Absolutely, yeah.
That's fascinating, Ivan. Thank you very much for your insights today.
Thank you.
Thank you also to everyone for listening and watching. If you liked what you saw or heard, please subscribe, share, or leave a comment. And for more insights like this, and to search, find, and compare hundreds of investment products, all in the one place for free, including the Ausbiz Capital GroWise Fund, go to investmentmarkets.com.au. Thank you.